Hello everyone. My name is Kamal Manocha. I represent PMS AIF World. Taking the rhythm of Friday webinars ahead, today we have amongst us Mr. Kuldeep Gangwar from ASK's portfolio management team. ASK is one of the leading portfolio management services. We have been seeing various PMS and AIF products that have come across over last 2 decades, and that have compounded wealth because of consistency and longevity, which are the two traits which ASK follows. In the popular portfolio of ASK that we have always heard is India's entrepreneurial portfolio. In 2018, ASK had launched domestic resurgence portfolio, keeping in mind some of the drivers which were showing structural shifts that were helping a lot of domestic companies and domestic industries. But maybe that time was less conducive. Now, when everyone is talking about India and India's domestic economy, the times look all the more conducive, despite the times in last 5 years not being that conducive. The strategy has generated decent returns. When I say decent returns are like closer to 18 to 20%, and that's what we ultimately seek from a portfolio manager in long term, which is aiming consistency and compounding. Welcome to you, Kuldeep, for this webinar. So the format that we'll follow will be that you have to give your presentation on the product in terms of philosophy, approach, the target construct, and then followed by that we'll do questions and answers.
Sure. So should I start the presentation now?
Absolutely.
I hope my slides are visible to you now.
Perfectly fine, yeah.
Yeah. Thanks everyone, and welcome to all of you for the Friday evening presentation. So this particular product is Domestic Resurgence Portfolio. Before coming to this particular scheme, what is consistent across any of our scheme? It's all about how we do it. Like irrespective which portfolio construct we are discussing, size of opportunity, quality of business, quality of earnings, good management, and price value gap. These are the consistent parameters which we look for. And this is standard irrespective which we are discussing, whether IEP, DRP, or any other strategy. So our focus is always on the certainty of earnings, compounding, quality, and return on capital employed. Now, before coming to this particular product, it always matters like which kind of a global environment we are in. So if you go through any news channel, newspaper, we come across like inflation is sticky at elevated level, once in a lifetime, once in a decade, fear of economics not doing well, high global debt, and so on. So this had been the headlines for last 1.5 years, which were keeping most of the markets down at least till March 23. Now, if we think about, say, how the things are progressing in last 3-4 months and what we think for, say, next 6 months or year. So the way we discussed about inflation, it had been the buzzword for last 1.5 years, since October 21 onwards particularly. And most of the central bank globally increased the rate. So US reached more than 5%. Our own, repo rate moved more than 6%. But it looks like we have reached to the top. So if we think about, say, 3 months, 6 months from here onwards, basically we are talking about neutral to positive scenario, like incremental scope for the rate hike. US looks relatively lower. In our own case, it looked like we have already reached the peak in April, and right now we are in the pause mode. So from the narrative perspective, it appears that worst is behind. At the same time, during this action, we have seen one thing had been consistent, and that was the delivery of earnings coming from the corporates. Because the narrative was negative while the earnings were coming, it led to a situation that valuation also became quite compelling. If we look the current situation, in last 1 year, the things are working in a favorable direction, like commodity prices are coming down, metals prices are coming down, and so on. And we have seen the same thing about edible oil. So inflation, which had been a problem for quite some time, had been a sticky number. It is gradually coming down, and we believe probably we are quite close to, say, peak of the inflation. And now the things should keep on coming down, whether it's India or for global markets. So it's about crude oil, which get the headline in journal like it hit more than $125 per barrel last year when the Russia-Ukraine war broke out. Since that, it had already come down a third by a one third. Same is the case with the supply chain normalization, like freight rates, which had gone through the roof during the COVID time. It has also corrected, so it's providing some tailwind to the operating expenses getting normalized, and which should provide some support to the margin in time to come. Food price index also hit the peak last year. It's also coming down from its peak. Net, if we think about the global scenario, it appears that relative stability and probably not so negative news in near term, which appears to be the case. In this context, why India? So when we think about our own country, so from GDP perspective, we are going up in the ladder. Like we used to be at 13th ranked in 2000, improved to 9th by 2010, close to 6th by 2020, and probably by 2027 onwards, it should come to number 3. So from, say, overall significance perspective, we are doing well. If we think about, say, overall return perspective, then USA had been the best performer for last 10 years. But if we keep the developed market aside, India had been again the one of the best performing market, whether it's a developed market or developing market. Today, if we think about next 6-7 years, like this journey of $7 trillion economy is being covered by only a couple of economies. One is US, second is China. US took almost 11 years to complete the journey of $3.5 trillion to $7 trillion. And China took almost 5 years. We are currently at close to $3.5 trillion. And we expect that by 2030, we should also close that number. What happens when somebody crosses the GDP per capita of close to $2,500, which had been the case with many economies? If we go by the history, then most of the economies where the GDP per capita of $2,500 is being crossed, the per capita growth had been almost double digit or more than double digit CAGR for next 10 years. Hopefully, India should also go through that path. And so it's not only about economy, individual level prosperity should also improve. In this context, this particular product like domestic resurgence portfolio come into the picture. It's more about being overweight on the India story, where we come to know many people are talking about it's India's decade, India's century. So why not a product primarily focused on the India story itself? So there are 4 major themes in the country as we speak. First is consumption, second is financial, third is infrastructure and manufacturing, and fourth is the digital India. We know that in India, almost 60% of GDP is attributed to the private consumption. And this is going to be the anchor for even years to come, decades to come in our country. The reason is simple, that people are upgrading from unorganized to organized. They are premiumizing, lifestyle changes are happening. And there are the companies which have the, say, wherewithal to withstand any incremental pressure coming from any part of the world. So the leading companies generally have the distribution reach, scale, they have the brand presence across the price points, and likely to do well. Even in the emerging channels like modern trade and e-commerce, these leading companies are relatively better placed because they have relatively higher market share over there. As this particular chart shows that whether it's aspirers, affluent and elite, the prosperity is actually improving. And if we think about our own country, this country can be split across 3 different buckets, like top 6, top 7% account for almost 50% of the GDP. Next 7% having $3,000 plus per capita, much higher than the average number. So if the migration is happening towards a middle class, upper middle class, or affluent, it augur well for, say, listed companies because they offer the products which people aspire for. It helps even better for the discretionary consumption because once the basic needs are being taken care of, the people go for say discretionary spending. It can be consumer durable, it can be say jewelry, it can be alcoholic beverages, and so on. So we believe that discretionary spending and discretionary consumption should be having a good time ahead and it should compound at least mid-teen CAGR for years to come. If we think about working age population perspective, China had its peak about 10 years back, and we are young and likely to remain young for next many years to come. Our working age group peak will be happening say 7-8 years down the line, so a long way to go. And in that environment, the employment opportunity will be emerging. At the same time, as I mentioned, that there are many categories where the per capita consumption is quite low, penetration rates are quite low, and they should benefit when we have relatively more surplus. So before coming to the financial theme, so consumption, you think about, say, when we say discretionary, it may be company like Varun Beverages, which has done quite well because government was providing the roads and electricity. So it was increasing the access to the consumer, and that helped the company quite a lot in last 4-5 years. Same is the case with the say Radico Khaitan, like when we think about premiumization, having good control on their own destiny, the company has done quite well. Company like Titan, like you will recall 20 years back, it was more about a concept of family jeweler. People will be staying at one place, visiting to the same jeweler whenever any occasion is there, which is not the case anymore. People are moving from one state, one city to another because the opportunity exists there. At the same time, the desire do exist, like contemporary design. We love jewelry, so at the same time, we want to have peace of mind, uniform experience, and Titan had provided everything at one place. And that's the reason the company had done well in last 5 years, 10 years, or last 20 years, and we believe it should continue. Point is like consumption overall is a big opportunity. It had been there even in the pre-COVID scenario and should continue to be the case for many decades to come. So this is one of the area from where we source a large part of our portfolio. Next big theme is financial. As we say, any good economy does require a good financial system, and credit growth is quite linked to how the GDP itself is growing. And we would have seen last year, about 23, the nominal GDP growth was quite good. It reflected in a strong credit growth for companies. We believe if for next 10 years we are going to have good economic growth, it does translate into the better future for the companies which are working in the financial domain. Whether it's a good NBFCs, private banks, insurance, all should do well. So this is another big area from we source a decent part of our overall portfolio. So banking industry, the good part is the NPAs are coming down, return on equity is improving and probably inching up, and probably India would be among the only few countries where this particular trend is visible. Third theme is infrastructure and manufacturing. So whenever a crisis happens, sometimes it's a boon in disguise. And you will recall in 2020, all of a sudden when everybody was having an inward looking focus, we realized that it's good to have self-reliance, manufacturing in India. And this particular theme is getting traction more and more. So if today we look for, say, whether railways, metro rail network, airports, road network, highways, it is the area where most of the capex is happening. It not only help, say, these particular sector, it's having ripple effect, or say say multiply effect in other sectors as well. As I mentioned about say Varun beverages. So earlier, when the road access was limited, electricity was not present. So the areas where it could gain the distribution access, those were also limited because it does require that you have to have a freezer where these soft drink can be put in place. It's changing because now there are better roads and there is electricity as well in tier 3, tier 4, etc. Tier 3, tier 4 cities, etc. That's the reason those are the companies also benefiting from the better access available. So most of the leading companies are benefiting because of the two trend. One is the urbanization, like people are moving from rural to urban, and these are the areas where these consumer companies are quite strong. Second, they are also trying to penetrate into say tier 3, tier 4 cities, and they can do it because the infrastructure is available now. And what are the factors driving all this? Like earlier, we used to talk about only China plus one, and in last 1.5 years, we have also started talking about Europe plus one, and it's happening across sectors, whether it's a chemical, IT, and so on. In our own case, the domestic market is quite huge, so it provides the scale to most of the say companies. We have the supply of manpower, right policies like PLI, and there is a strong focus of the government that we should manufacture as many things as possible in country so that we have say self-reliance going forward. If we look the current indicators, you all will be keeping a note that how the GST is doing. So it had been the 6th month in a row where we have crossed more than 1.6 lakh crore or so. And this number is inching up in terms of its contribution to the overall GDP. PMI is also improving. As you would be keeping a note of like where the government is spending. So in the overall expenditure, the capex is gaining more traction. So today, almost 22% of the expenditure is getting to the capex part, and capex is having its own multiplier. It provides the employment. It also have the positive impact on the consumption as well. Next is digital India. Like India is a success story which many people want to replicate, and it's providing an ecosystem where the new platforms are coming, new companies are emerging, new way of the businesses are happening, and it also helps in the kind of employment opportunities available across the board. Today, if somebody is the entrepreneur founding any company based over the new age platform, that guy probably would have been in US or somewhere else if that opportunity is not available. At the same time, if you think about, say, employment opportunity at the lower end, earlier if somebody used to move from, say, rural area to urban area, the employment opportunity used to be restricted to, say, construction, real estate, and so on. If those sectors are not doing well, then probably the lower end of the strata was suffering. Today, if Swiggy is growing, Flipkart is doing well, Amazon is doing well, then probably the opportunities at the lower end are also improving, which is a good news for the overall ecosystem. So till now we have discussed about say fundamental part of it, like our economy has done well, having good prospects. Now the question comes, how the people across the world are responding to the same. So if we look, say October 21 onwards, there had been negative bias because the overall market was not conducive. I mentioned the reason in the beginning of the presentation itself, like whether it's a Russia-Ukraine war, inflation, interest rate, and so on, a lot of negativity. So FI flows were negative, and it had implication for many high quality, high growth companies because those are the areas where the FI is also invested. So irrespective how good those companies were doing on ground or delivering in terms of number, it did not translate into the good stock return in that particular period of October 21 till March 23 or so. Since last 4 months, the FIs are coming back and they will buy the same thing what they understand, which is leading companies offering good quality growth for years to come. And that's the reason the earnings had been there all across. Just because the narrative was negative, people were pulling out the money. And at the margin, because the things are looking relatively more positive, the things are coming back to normal, and which is helping to the growth company, irrespective whether consumption, financial, or manufacturing. When FIs were withdrawing the money, at the same time, our domestic flows were quite resilient. It had been the case for many months in a row, and it continued to be the case. So earlier, say, FIs were pulling out the money, it was offset by, say, domestic buying. And right now, the situation is that FIs are also buying, and domestic institution, domestic retail, both are putting the money. This is how the overall market behavior in last 30 years. One thing I will like to highlight, that it may appear that fundamental requirement to have a stock return is simple, that earning growth should be there. Like in last 30 years at the index level, almost 12% CAGR in the earnings, almost similar sort of stock return. But one thing is visible over here, they may be always lead and lag. During FY08 to 19, there was only 6% earning growth, but price performance was relatively better. In last 4 years, earning growth at the market level was quite superlative, like close to 19% CAGR. But its translation into the stock return CAGR was relatively lower, only 11%. Reason I also mentioned, because there are noises which happen for different reasons. It may come from rest of the world as well, despite we doing well. So these are the times which are actually an opportunity, when the earnings are coming and earnings are going to come. At the same time, market is responding to some short-term negativity. If we think about Nifty, so it may appear that Nifty trailing P is currently quite close to its 10-year average, but we should keep in our mind that mix of the Nifty itself has changed. 10-year back, a large part of the composition in the Nifty used to be, say, metals, oil and gas, PSU bank. They used to be, say, almost 37% or so of the overall benchmark composition. The contribution has come down to low double digit now. And where this contribution has gone? 10-year back, almost 12% contribution used to come from, say, consumer names, private banks, NBFC, and so on. Today, they account for almost 45%. So basically, the mix is quite richer. And when we think about private bank, NBFC, or consumer-oriented sector, they traditionally command, say, higher valuation, because they also offer the higher growth. So what we have seen last 4 years, there had been reasonably good pace of growth coming at the index level. At the same time, say, just because the mix has changed in favor of a high quality, high growth company, so probably the last 10-year average itself is not the right benchmark to look at. Nonetheless, because derating was happening, we are quite close to the lower, this average level. We suggest only one thing, that valuation are relatively more reasonable vis-a-vis what probably it used to be 1.5 years back. If we think about next couple of years, at the index level, the expectation is that the earning growth should be 15% CAGR. Now about this particular product, like ASK domestic resurgence portfolio, we start with the BSE 500 companies. We are focused on domestic opportunities. We apply all the filters which we have discussed, like regarding management, opportunity, corporate governance, etc. Then we apply the filter of export less than 20%, because it's more about India's story. Then we apply the filter of return on capital employed more than 25%, earning growth more than 50% or so. Actually, we are left with less than 100 companies. Out of that, we have built the portfolio of 20 to 25 stock. If we look how these companies have done in last 5 years. In last 5 years, say, earning CAGR for the portfolio would have been 22%. Significant positive delta vis-a-vis the benchmark. So on-ground delivery had been quite good, irrespective of the turbulent period. Like last 5 years, every 6 months, some disturbance happen. The source may be local, source may be global, quantum may vary. So whether, say, trade wars in 2018 beginning, at the end of 2018, we had the ILFS related issues. 2019, we had general election. 2020, we had COVID-1. 2021, we had COVID-2. Then last year, we had Russia, Ukraine. Everything was happening. But these companies delivered, say, 22% earning CAGR. So fundamental side, irrespective of the situation, they delivered. And we believe it should continue for even years to come. Like about 24, we expect almost 24% earning growth for the portfolio and close to 25% in about 25. If we think about, say, composition, as I mentioned, that there are four major themes in our country. One is the consumption, second financial, third is the manufacturing, and we are the overweight in all those themes. So consumption account for almost 40% of the portfolio. And when we say consumption, it tries to cover almost all the subcategories possible, whether it's a staple, it's a discretionary consumption in form of durable beverages, alcoholic beverages, retail, and so on. So it's an overweight area, and it has done quite well in last 5 years as well. And we believe it should continue for next 5 years or 10 years. Financial is another big piece. I mentioned that any good economy does require a good financial system. So we have taken exposure through good NBFC, whether it's a Chola, Bajaj Finance, banks like SDFC Bank, AU Bank, ICICI Bank, as well as, say, insurance company like SBI Life. Third big piece is like manufacturing. So manufacturing, there are companies like APL Apollo, there can be cement company like Dalmia Bharat, and there are companies like, say, KI Industry, Polycab, though we slot those companies in consumption, but basically they are the key beneficiary of, say, CapEx infrastructure spending, which is happening in the country. When we think about, say, digitization, etc., we have exposure towards, say, Infosys, Bharti, and say Reliance in this particular portfolio. This is the psychographic, like how the earning growth looks like. 30% plus ROC, ROE is 20% plus or so. This is the interesting part. Like if we think about valuation and look the last 5 year history, and as I mentioned, there had been many disturbing event happened or experienced by our own economy. So at any given point of time, whenever crisis happen, there is response coming through the companies in terms of the stock price correction and so on, and its reflection in the valuation. Today, we are quite close to the valuation, which you can call the bottom being experienced in the last 5 years. Like whether March 20, we were again close to 40 trailing P for this particular portfolio. Then in June 21, again the similar situation when COVID-2 was there. Last year as well, when the Russia-Ukraine was happening, almost similar situation. And it's happening despite the earning growth is coming on the ongoing basis. Even last year as well, there was 20% plus earning growth. But the derating was so sharp that the translation of this earning growth in the stock return was not there. I think it's an opportunity. Because what happens that if the fundamentals are in place and it's not translating into the stock return, it's getting accrued. As I mentioned that there is always lead and lag. At times earnings do come, but it does not translate into the stock return. And probably that is the situation as we speak. We have seen enough derating in last 1.5 years, and we are quite close to, say, bottom of the valuation being experienced in the last 5 years. And as we speak, for next couple of years or even beyond, earning growth expectation looks superb. So you will agree that for any stock return, two things are there. One is earning growth and response to that earning growth by the market. In last 1.5 years, market did not appreciate that particular fundamental delivery. But sooner or later, they have to say or do it. And today, fortunately, the valuation look relatively more reasonable. If the earnings are going to come, a decent part of that earnings should translate into the stock return as well. Most of the companies which we are having in portfolio make new lifetime high every year. This is how the return had been, like 1 year, 2 year, 3 year, 4 year. So Despite FY23 was not a great year, returns had been relatively reasonable, and we have already mentioned that if the earning growth is going to come, valuation are reasonable, then decent part of the earning growth should translate into the stock return in time to come. So we are always focused on the opportunities which are compounding in nature and more sustainable. So that remain the crux or the underlying theme for any of the ASK strategy. The differentiation is that this particular product is more focused about India opportunities. Like if we say India is one of the best place to be in from the economy perspective, so why not a product which is largely focused on India itself? So that is the theme. This is how the portfolio is being constructed. I will stop over here and will be happy to have any question which you might be having.
Sure, Kuldeep. I think this was a very interesting presentation. You will have to stop the presentation. I'll do that for you. Perfect. So, see, the thing is, the presentation on India is always, rhetorically looking very attractive, and we Indians are always attracted to that. And most of our investments, when I put up myself in investors' shoe, have maximum exposure to India, and maybe this is the right time to have that exposure. Now, every fund manager, there are fund managers who talk about manufacturing as one of the themes. That is one of the themes that you have also in your portfolio, right? Some other fund managers would talk about something like exports as a theme. There are fund managers who talk about consumption as a theme. You have maybe, all these 3 4 themes in your portfolio which are like, domestic focus, but the core thing is that we are focusing on the possible growth of India's economy, and we are kind of looking forward to it. However, in the current context, in terms of market timing, in terms of market valuations, in terms of the interest rate environment where we are kind of, presently prevailing, where do you see, in what phase of market we are? Because one is to talk about, obviously, in long term, yes, things are good and everybody understands that, but obviously, you are here as a fund manager. The foremost question which anybody would have on their mind, and I can see on the chat, in such a high interest rate environment, what is the kind of, answer that you want to give to investors who kind of think and worry and try to time the market?
Sure, good question. So it always comes. So if we look last 25 years or even a longer period, you will notice one thing, that the crisis used to happen at longer intervals. Like one big crisis was in 97, like Asian currency crisis. Then 2001 or 2, we had the tech bubble burst. Then third big crisis happened in 2008 when the global financial crisis. Then 2013 we had the taper tantrum. One thing was common, that there is one crisis here, then 4 good years. 2016 onwards, we don't have that luxury. So 2016 we had the demonetization. 2017 we were struggling with the GST related disruption. 2018 beginning we had trade wars. 2018 fag end we had the LFS. 2019 we had a general election. 2020 we had COVID-1. 2021 we had COVID-2. 2022 Russia Ukraine. So point is, like you don't have that luxury that when everything will be right, noises will be right, then I will invest. You have to invest in the environment where the negative news may come from any corner, not necessarily from India. It can come from any corner, and we are living in a very connected world. So Russia-Ukraine's problem is not only Russia-Ukraine's problem, it's implication throughout. Like if they fight, it's having implication on crude oil. If it moves up, it's having implication on interest rate. If its interest rate is rising, so discount rate also increase. Like asking rate, the people look for, like when the fixed income itself offers a 6%, 7% or so, then if you want to come to equity, your expectation also go up. When it goes up, it's having implication like kind of price you want to pay for the equity and the kind of expectation you're having for return perspective. Point I'm trying to highlight, that a portfolio has to function both way. Like when the time is not good, the portfolio should be able to provide a good defense. When the time is conducive, it should be able to participate in that growth trajectory. Okay. What happens when the stock market is moving up? We generally think about how much absolute return is being made by one strategy versus another. We forget about the time when the things will not be working in our favor. So we should also take into consideration the strategy which has done well, okay, in those tough times. Because what happens, people need the resources, the money only in tough time. In the good time, they have multiple resources, multiple avenues available. As I highlighted, this particular strategy came in 2018 beginning, and the reason making this particular strategy this way was the same. Like world is going to have more inward looking focus, more self reliance. There will be many plus minuses happening throughout the say time to come. It has seen it all, this particular strategy, like all the tough time, all the negatives. That's the reason I showed the valuation part, that obviously it's all equity. We don't take the cash call. We do believe the only HNI, family offices, and the people who can do the asset allocation are investing in these products. So if somebody is giving money to me, it's more about equity allocation. So it should be just how it's doing vis-a-vis say other equity products and
Sure.
overall market. So in FY20, when the market crashed by 27%, that COVID year, this particular strategy declined only 16% or so. Probably right now we are not discussing those aspects because the market had been either positive bias or stable bias. Okay. So that sharp correction, when it happens, then we realize that we also need a good defense. Point is like when we think about equity investment, we have to think about both the aspects. So when we think about consumption, it provides a good defense because the company's character is like that. Okay. So when the upturn happen, at times they may drag, but we have to think all the cycles put together, how much the overall return is delivered, and with how much volatility. Like if you look the beta of this particular portfolio, it's a 0.9. Vis-a-vis it's lower than the benchmark itself. So even if the same return is being generated with relatively lesser volatility, it should be appreciated. And second part, like how it has done in the tough time. Point I'm trying to highlight, like September 21 onwards, the world was always worried about one crisis to another. Reasons may be coming from anywhere. And equity market, there are three factors required. One is the narrative, like how the market is thinking for 6 months or a year. Second is the earning delivery. Third is the valuation. For 1.5 years from September 21 till March 23, narrative was negative. Like we were only discussing about next interest rate hike, inflation figure and so on. April 23, RBI took a pause. Like probably we reached our own inflation number from where the things were not worsening. So they stopped taking the further interest rate hike. In June, Fed took first pause, though they have increased the interest rate in recent time. But now we are talking about probably the next hike should be the last one. And so basically at the margin, we are talking about either neutral to positive commentary. Okay. During this time, what we were responding to, we were trying to respond to the inflation part. And as I've shown that the inflation gradually is coming down and probably it's reaching to the level where the most of the central bankers will be relatively more comfortable. Then the next talk will start when the rates will be cut. It may be the case that they start coming down by next year rather than coming down this year. Net point I'm trying to highlight that narrative at the margin is not negative. Okay. Second part, which is equally more important, is the earning. Like everything is happening in macro, how the companies are doing on ground. As I showed you, during FY19 to 23, the earning CAGR was at the market level close to 19%. Our portfolios are even quite superior. Okay, so fundamental delivery had been intact. Third is valuation. As I mentioned, because the narrative was negative, FIs were pulling out the money, valuation levels have come down. So it's all about perspective. As long as I mentioned, that ultimately stock returns to happen, index to move up, earnings is the fundamental requirement. And we should be actually quite happy if the earnings are coming and the market have not responded. That make our entry relatively more reasonable and make sure if we invest now, if the earnings remain in place, then high likelihood that upcoming earning growth should translate into the stock return.
Okay. Sure. Kuldeep. So basically, the point that you are trying to highlight is that your portfolio has evolved over years, has seen various market cycles, show resilience during the uncertainty of COVID,
Yeah.
and for any investor who is worried about market timing, should actually find solace in this portfolio because it's a quality portfolio, and in terms of expected earnings profile of the underlying companies, portfolio is quite confident.
Yeah.
This is the point that you're trying to make, but also I would want you to add on to some numbers in
Yes.
terms of guidance with
Yeah.
regards to the valuation of the portfolio as well as the earning, average earning of the portfolio.
So if we look FY25, we will be close to 29 fee for the portfolio level P. And if we think about FY24, we expect close to 25% earning growth for portfolio, and same is the case for FY25 as well. So though we keep the cutoff of close to 15% for any company to become part of the universe for this particular construct. But actually, as I have shown you, from FY18 to 23, average earning delivery had been 22% CAGR. And we believe it should continue to be the case if we are talking about in normal scenario. Last 5 years, I won't say were the normal years. In so-called tough time, the companies were able to deliver. If we talk about relatively normal scenario, the earning growth should be either at par or superior.
The kind of portfolio turnover or churn that you follow, or what is the history in this regards?
So average holding period is almost close to 3 years. So it's almost close to 5 year journey. So 2.8 years was the average holding period. So unless it's actually required, like you make a thesis and it's not playing out that way, we keep the stock in our portfolio. Only thing we do, like trimming the position if required. I will give the example of Varun Beverages. Like we bought that stock in 2018, and that stock has become almost 7x, 8x in last 5 years. So what we do, like we keep on trimming as and when required, but it still remains among the top 5, top 6 position at any given point of time. Same is the case with many other names, whether it's a Bajaj Finance, Titan, and so on. So just because your stock has done well should not be the reason to make any exit out of it. Actually, the people who do well have the ability to deliver for even time to come. That is a basic philosophy we believe in. Like capability on the sustainable basis should be appreciated.
Sure, Kuldeep, but at the end of the day, the alpha in the portfolio is very important, and investors ultimately select investing into a PMS on possibility of alpha. Absolutely, in longer term, consistency in return does generate good wealth. And you rightly kind of mentioned that portfolio which delivers returns across market cycles, and obviously shows lower beta and is kind of showing resilience during uncertain times, is a good portfolio. And ASK's most of the portfolios have shown all these traits. But at the same time, the portfolios, I would say, allocation or concentration, and maybe the underlying holding, I would say, longevity should be such that it ultimately aims to beat the benchmark. Now, in that context, what is the benchmark that this portfolio would have, and what is the guidance that you want to give to clients in this context?
So BSE 500 is the benchmark for this total return index. And as you rightly mentioned, that when the market is dynamic, the opportunities do emerge. So in 2018 beginning, when this particular portfolio was constructed, almost 90% say portfolio used to come from only consumption and financial. In 2020, the opportunity started coming from other areas as well, whether it was say manufacturing and so on, or recent times chemical. So rather than being focused only on couple of themes, it has become broad based. Like APL Apollo came in 2020. Even the nature of the consumption is changing. Like if you look till 2021, it was more staple, like FMCG company, whether it's a Nestle, Britannia, Dabur, and so on. Today, it's more discretionary consumption. Like 2 years back, we took a call that irrespective of how good the company is, we are more focused about the return part of it. Company which we are choosing is equally a good company. It's all about its ability to deliver earning and generate the return for us. So last 5 years, it may look like the consumption had been quite stable, large part of the portfolio, but the character of the consumption is changing. Like today, consumption, it's more about, say, Varun had been consistent because that company was performing day in, day out. Like last year as well, it doubled. Okay. But 2 years back, we introduced Radico Khetan. That stock also doubled. Then we moved to Polycap. Last year we introduced KEI. So it's more about spotting the opportunity, direction where the things are happening, and become the, say, part of it. So at the overarching 30,000 view, it may look like the things are quite constant, but things are underlying current is actually changing. So we are keeping a note of it, where the economy is moving and which are the emerging areas. So as I mentioned, like ultimately, it's earning which count a lot more. Appreciation of earning may be delayed but not denied. So that is the fundamental part. So this had been delivered in past. This is delivered last year, and this is the part we are quite confident that the earning CAGR should be more than 20% for years to come. And if it happens, whether it's a 6 months, year, it has to get converted into the stock return. It's getting accrued rather than getting denied, the way I will put it.
Sure, absolutely. All that is well understood. The subsequent question, that comes to my mind if I try to put myself in investor's shoe, because ASK is a well-known name, with more than 2 decades of experience and products both in PMS and AIF space. How is this particular portfolio different from the earlier portfolio? Because there could be many investors, many clients who already have exposure to something like ASK IEP or ASK ISP or ASK growth. Now, if that investor or that client wants to make up his mind to add more to this portfolio, he needs to understand what is the duplication in this portfolio.
So as you mentioned about ASK IP, which is our flagship scheme, almost close to 20,000 crore AUM or so. I would say in terms of differentiation, probably this is one of the strategy which is having a lot more differentiation vis-a-vis any other scheme vis-a-vis IP. Like today, overlapping will be close to 48% or so. They obviously, differentiation should not be for the sake of it. It should have merits. So for the right reasons. And at times it's because of the size, at times because of the choices we make. So it had been largely domestic focus. So we took more of the consumption, more of domestic opportunities, and size also matter. Like as I mentioned, the name like Radico Khetan, it was easier to take in this particular portfolio. Second, how much you take, that is equally important. In a bigger portfolio, if you are making a small cap contribution, there are limitations because of the liquidity, size, etc. You can have a relatively larger, say, exposure being taken. And as we speak, because of its size, today IP will be having 70% large cap and 30% small and mid. In this particular portfolio, it's almost 50-50, like close to 52% large cap and 50% balance, 50% coming from small and mid. And small and mid, not for the sake of it. Like we just go for the leaders, which may be in the categories which have yet to grow. Okay. So those companies may be leader in their own domain, but that opportunity is smaller as we speak, but may become a lot bigger in time to come. So because of size, because of the construct, they are the difference that had been there and should continue to be there in time to come. So almost 50% different vis-a-vis, say, IEP. And I will like to highlight one thing, that even a single stock can make a huge difference. Like Varun Beverage might be having 5% contribution in this particular portfolio. That stock double in last 1 year. Single stock can make a huge difference. So 50% is quite a number.
Sure, Kuldeep. Would you also like to highlight the allocation-wise, structure of this portfolio in terms of large, mid, small?
So as I mentioned, like close to 52% is large, and balance 48% is in mid and small cap. In the small cap, it's Radico Khetan, which is categorized as a mid small cap, but probably the way the stock has done, it's a matter of time. It may move to say mid cap and so on. We have seen the same journey for many of our stocks. Like Varun used to be, say, small cap or mid cap company 5 years back. Now it has become a large cap. Same had been the case with APL Apollo. So it's not driven by that we want to have certain exposure from a smaller mid. It's all about say opportunity should look good and should have ability to grow. As we speak from SEBI classification perspective, almost 47-48% will be coming from a small and mid.
So if I want to understand for you about you as portfolio manager for this particular PMS, what is your personal conviction in terms of selecting between any portfolio of ASK, if you were to kind of select between IEP and maybe domestic resurgence portfolio, and how will you make that decision?
So I would say it's not difficult because if you look IEP, it had been all entrepreneur driven names. Like that is the driving factor, or say that is from where the IEP start. Like it should be all entrepreneur driven. In this particular strategy, we can have say companies which might be run by the professional as well, like ICICI Bank, SDFC Bank, etc. Can become the part of DRP, cannot become the part of IEP. It's not one versus another. It's more about you choose a theme and stick to the same because the opportunities may be available in both the domain. So if it's there, we will go for it. As ASK, if you look for, we like the people who have skin in the game. So even though we are saying professional led, but any portfolio of ASK would be having almost 80% firms run by the entrepreneurs only. Reason is simple. If you look 2020, which was a COVID year, a promoter will do the level best to come out of any adversity. And we have done this analysis over a long period of time. Barring CY22, where the entrepreneur-driven companies did not do well in terms of the stock return part. Okay. Otherwise, those were better performing in terms of the earning delivery as well as the stock return part. So the way I would say, like underlying tenet is go for the people who can deliver. In this particular portfolio, we have the flexibility to go for the people if they are coming from, say, professional background as well.
Understood, Kuldeep. This is the last question of this webinar. So you have been part of ASK's, portfolio management team for more than 5 years.
Yeah.
And over the last 5 years, we have seen, all types of events happening that you were kind of talking about, from ILFS crisis to COVID to increase in interest rates recently. So over these events, when all these events were happening and you being part of this largest, I would say, alternates focused investment house, what is it that, you think that, definitely you have learned and something, which you kind of carry with you and that has helped you now maybe, implement and execute portfolio management in a superior way over next 5 years?
So the way we think about it, you cannot ride on the borrowed conviction. It should be of yours. So, and there are always times when everybody question, like why you are doing the things in a certain way. We have realized if you are sticking to a particular philosophy, sticking with the good people, good companies, they do come back. Okay, they may be down for a while, but they are not out. They do come back. You have to stick with them and you have to pass your time. Sometimes the only answer for many problems is the time itself, rather than trying to do many things get changed. Like as I mentioned, September 21 till March 23, it was a tough time in a way. Like companies were delivering. Okay, we can question the company if they are not delivering the earnings. They were delivering on ground, but it was not translating into stock return. So fundamentals were in place. Questions used to come from different corners, like why don't make a change? We say like we should make the change when it's absolute necessary and the fundamentals are not correct. So we have seen like stick to a ground. It's a matter of time things will come back, as they have started coming back in last four months, because sometimes stock market is combination of multiple participants and their motives can be different, their compulsions may be different, and sometimes even the good companies do not get appreciated. So patience is the virtue which is being required, and it make you a lot more humble, all this experience. So humility become the virtue of, say, portfolio management, which help you even for time to come. Like If we say art and science, today we have realized it's more art than science. Science, we all know these are the good company delivering earnings. It's all about the behavioral part, like how we respond to the same situation. So something may appear a crisis to someone, it may be opportunity for someone else. So behavioral part is more important and continue to be important because the way the world is panning out. So this is the key takeaway of last 5 years, probably going to help for next 5 years or 10 years as well.
Absolutely, I would 100% agree with you. And we see this, we feel this, in the overall, I would say, philosophy. And when we talk to any of the fund managers or any of the key thinkers, be it, Mr. Bharat Shah, or I'm talking to you, with regards to ASK's investment philosophy. And I would say we always kind of aim and expect and wish for alpha, but in longer term it's the consistency which ultimately compounds wealth, and longevity which compounds wealth. And at the same time, it is the conviction to hold on and remain invested over a longer period of time which ultimately creates more wealth. Because at the end of the day, when we compare products, obviously one feels that yes, at the time of investment, I am focused on finding out a product which is giving very good alpha. But from the point of view of actually creating wealth, it requires that one invests in the product which one understands well, which is simple enough to stick to it for long term with conviction, and ultimately one ends up gaining a lot of wealth creation. And that's what I think ASK is all about, and that's what ASK has always aspired for. And that's what I always kind of see, when I kind of talk about ASK as a fund house. Thank you everyone for joining once again on this Friday. We'll be again connecting next Friday. Thank you, Kuldeep, for your time.
Thanks everyone. Have a good evening.